But okay, so I wanted to do a piece on diversification 101. This is, I think it's a heavy piece. It covers a lot, but hopefully, if you're looking into diversification and what kind of metrics are commonly used, I kind of wanted to outline everything here. The process of diversifying it's a pretty personal process. It really depends on your profit goals, your risk tolerances. So this doesn't really get into exactly how to go about the process of diversification. It more so provides like an overview of what the first things are to kind of consider when approaching diversification and whether or not it's right for you. Let's get into it. So first things first, diversification. So broadly speaking, diversification is the practice of spreading portfolio capital across a variety of different assets. And what the goal of that really is to sort of like reduce the portfolio sensitivity to very specific risk factors, whether those are company specific risk factors or sector specific risk factors, or even like market, geographic, specific risk factors. What we're trying to do is sort of like reduce a portfolio sensitivity to that by spreading portfolio capital across a variety of different assets. And these are known as idiosyncratic risk factors versus systemic risk factors, which are a bit different. So these risk factors, these idiosyncratic risk factors would be like ones that are very specific to a particular asset, whether that's a specific company, sector, asset class, and those can be reduced with diversification. Versus systemic risk factors, those cannot be diversified away, basically. So systemic risk factors are basically risks that are kind of inherent to the market as a whole, something that causes markets to, exhibit extreme volatility because of systemic problems. That's something that diversification just can't fix. So it's important to note between the two. We can't eliminate all of our risks with diversification, but there are certain types of risks that we can diversify, and those are called idiosyncratic risk factors. So when it comes to diversification, let's take a look. There are pros and cons. Diversification, I think, is very important for sustainable investing, for long-term investing especially. But really, the decision of whether or not it's right for you to diversify, it's kind of a personal process, as well as the extent to which a portfolio is diversified. That's, again, a very personal process, and it really depends on your goals. So the pros of diversification, we talk about these a lot on the show, are that it tends to reduce long-term, portfolio risk, right? It tends to reduce that. We get smoother returns over time. It also tends to protect capital during sell-offs or bear markets. So when we do have one of these big market-wide events, it tends to reduce the impact on the portfolio when we have diversification. And then in addition to that, when you have a broad exposure to, all these different asset classes, all these different types of companies and sectors, it does also mean that there's more potential growth opportunities. So, a sector today that might not be performing, especially well, might perform very, very well within a couple of years. And when you have a little bit of exposure to that, you do have a little bit more potential growth opportunity because, again, it's spread across a pretty wide variety of different investment vehicles. But the cons, a big one is that it does require time and research to set it up. So in order to, set up diversification, you got to really research exactly how much diversification you want in order to receive a certain, desired level of growth with a, preferred level of risk. And then it also requires rebalancing. So you have to kind of go back and rebalance the portfolio depending on how the market changes. And there's work and time that's involved in that. But then another con is that it might also limit upside growth in the very short term. So if you're trying to get 100% growth in a month or something like that, then arguably diversification is going to potentially hinder that. And then in addition to that, because you're trading a wide variety of assets, depending on how you're actually managing your portfolio, like what service or software you're using, that might, incur additional commissions and fees, which is kind of another thing to consider. So pros and cons, and again, the right thing is a very you-dependent thing. And that kind of takes time and a little bit of research to figure out. But what I really wanted to focus on here is really how diversification is measured. And it can be measured in a variety of different ways, but I really wanted to focus on kind of two broad classes of diversification metrics, either asset characteristics or ones that are based on price data. So let's start with asset characteristics. When we're talking about portfolio diversification, it can be quantified by kind of assessing the characteristics of individual portfolio elements. And some of those kind of include asset class, for example. So equities, commodities, real estate, bonds, diversified, very, standard portfolio diversification is 60% stocks, 40% bonds, for example. Number two, this one I think is, pretty important, is sector as well, especially for option traders. Those sector-specific risk factors can really affect, especially for options traders, sort of portfolio volatility, which option traders are very sensitive to. Looking at like energy, technology, consumer discretionary, all of the different, potential sector classifications, and reducing some of the exposure to specific sectors like semiconductors, right? Everyone's been talking about semiconductors this year. So having potentially too much exposure to that sector can result in a much more volatility than you might want potentially. So just kind of like by looking at sectors and how those are represented in a portfolio can give you a very good idea as to how diversified the portfolio actually is. We also have market cap, which again, the right way to do this really depends on the investors. But we have different levels of market capitalization, and there's going to be different types of risks that are more or less likely depending on what the market cap of the company is. And then we have region as well. We talk an awful lot about North American companies. We talk about different East Asian companies. We talk about European companies, but there are specific geographical risk factors that are going to affect certain companies maybe a little bit more than others. For example, like with the Russia-Ukraine conflict, we saw energy prices grow significantly in different European countries, which significantly affected growth of the tech sector, for example, because of increased energy costs. And then there are some more advanced, maybe additional characteristics such as dividend structure, revenue source, tax treatment, currency exposure. But I think the first four, I think, are at least enough to get started in terms of understanding or initializing a diversification strategy. And then once you kind of get a handle on it, going into more advanced metrics, such as dividends, for example, or revenue source, tax treatment. Make sense?
Yeah.
Cool. Okay, so another thing that I wanted to note is that one way to get diversified exposure by trading a single asset is through ETFs. So ETFs, exchange traded funds, we talk about them all the time on the show. Basically, some collection of securities that tracks some underlying asset, sector, or industry in a particular way, in an inverse way, for example, or in a leveraged way, in addition to just sort of passively tracking certain commodities, for example. But because ETFs are comprised of several assets, they are inherently diversified and are typically easy to trade as stocks. But as a note, we talk about this all the time, it's very important to always check the holdings in an ETF before you trade it, because it might not contain what you're expecting it to, sort of intuitively. But either way, ETFs, just as a single asset, are a great way to get some diversified exposure to asset class, for example. So you have SPY, which are US large cap companies. You have GLD, which tracks gold, XLRE, which tracks real estate. You have different sector ETFs, such as XLE for energy, XLU for utilities, XLK for tech. You can also diversify by region. So you got EWZ, Brazil ETF or Brazilian ETF, FXI, large cap Chinese companies, EEM, emerging markets. So ETFs are a way to get using a specific asset, diversified exposure, and make that process a little bit easier. But it's very important to note the holdings, especially of the ETF, and then other factors potentially as well, such as dividend payments or dividend rates or expense ratios, for example, for maybe more advanced investors. So now we get into some of the fun ones. So for price data, so for more advanced traders, diversification can be quantified using certain metrics based on historic price data. I'm going to talk about a couple of these, but the ones based on price data, obviously, so these asterisks mean that you got to take them with a grain of salt because past performance, future returns, the whole thing. The market today is totally different from the market, a year ago, month ago, even yesterday. We're dealing with a different market every day. But that being said, price data, diversification metrics and procedures based on price data form really the foundation for modern portfolio theory, and a lot of quantitative analysis, quantitative portfolio rebalancing. Historic price data plays a large part of that. And I kind of wanted to show some of the simpler or more introductory metrics when it comes to using price data to quantify diversification. The first is returns correlation, right? We talk about this literally all the time. It's important to remember that correlation is calculated between a pair of assets. So in order to look at sort of the portfolio correlation and the correlation between the different elements, you have to look at it relative to different pairs. It really measures the extent to which those assets move in tandem. More specifically, it really indicates the strength and the direction of the relationship. We have other, segments kind of diving into correlation a little bit, as well as how to read it. But in a nutshell, this is kind of what it's quantifying. And obviously, when we're talking about price concentration, correlation is a really important metric for being able to quantify that. So here's an example of what a correlation matrix might look like. It is symmetric, so I just showed half of it because it kind of tells you pretty much everything you need to know. But when you use returns correlation, and very importantly also position size, you want to kind of use them in conjunction together. It's very, very, very commonly used to kind of like assess the overall portfolio diversification. So here I'm looking at two different portfolios. One portfolio has SPY, the NASDAQ, Apple, NVIDIA, and Tesla. Right, with +1, meaning that they tend to move with, together, they tend to move in tandem positively often. -1 is inverse correlation. So that means when one has a very large move to the upside, the other tends to have a very large move to the downside. And when we see a correlation of 0, that just really means that their movements tend to have no linear relationship is what that means, but they tend to have no really strong correlation. So when we look at the SPY, Apple, NVIDIA, Tesla, NASDAQ portfolio, we can see that some of these pairs don't have very high correlations, like 0.33, 0.32. And then some have very high correlations, like SPY and the NASDAQ is almost 1-for-1. So you have very similar risk factors, very similar directional tendencies between those two underlyings. But now compare that 3-month correlation of that portfolio to the 3-month correlation of a portfolio with SPY, NASDAQ, gold, XLE, and XLU. So now you still have two components like SPY and the NASDAQ that are pretty heavily correlated, but a lot of the correlations are much less strong between these other elements. You have much better diversification because the correlation between the different pairs in that second portfolio and that upper portfolio, they tend to be a little bit lower. Like XLE and QQQ basically have no correlation between those 3 months that we looked at. XLU and the NASDAQ also basically no correlation. So you're getting diversification by having XLU in this example in your portfolio with the NASDAQ. So those price correlations tend to be very low. Cool. So number 2, we did price correlation, returns correlation, and then the second one is portfolio variance. This is a very important part of modern portfolio theory, which is effectively a mean variance analysis with the goal of finding portfolios that have the highest expected return for a certain level of risk. And when we talk about risk in this situation, we are talking about portfolio, either volatility or variance. We are trying to find a configuration of assets and a configuration of weights that gives us the best expected return for a certain level of risk. The next one, we have portfolio beta or beta weighted delta. They kind of tell you something similar. But for a stock portfolio, it'd be portfolio beta. For an options portfolio, actually for both, you could use beta weighted delta, but typically options traders tend to focus more on beta weighted delta. But this gives you, we've talked about it before, a measure of systematic risk or systemic risk, and it really quantifies the volatility of a stock relative to the volatility of some benchmark, which is usually the market. The table of like how to read it just kind of gives you an overview of exactly what the numeric value of beta kind of intuitively means. So if you have a very large beta, a very large positive beta, it means this asset, this portfolio tends to have much more volatility than the market, or the movements tend to be much larger than the market. Beta of 1 basically matches the market. Beta between 0 and 1 is a little bit less than the market. If you have a beta of 0, the portfolio is basically independent of the market. And if you have a negative beta, it's inverse to the market. So this kind of gives you an idea of like just how sensitive or how volatile the portfolio is relative to the benchmark, usually the market. And again, this can't really be used alone to tell you if a portfolio is diversified, but again, it can be used in conjunction with other variables to kind of tell you if a portfolio is appropriately diversified. And again, here we're going to compare the beta of those two portfolios from 2022 to present, remembering that the larger the beta, the kind of more sensitive the portfolio is. And what we see here is obviously the more diversified portfolio, the portfolio with lower price correlations, portfolio 2, a significantly lower portfolio beta. So by adding these different ETFs together, we are basically able to construct a portfolio that's much less sensitive. The one really important takeaway here is that if you're trying to diversify a portfolio, there's really no one metric that you should be relying on. It's a collection of different metrics that kind of tell you different things in order to kind of diversify properly. And you can start with the more intuitive ones: asset class, sector, market capitalization, region. Like that still can give you, those variables together can still give you potentially a pretty good snapshot representation of how diversified a portfolio is. And then for maybe more advanced investors, moving into these ones that are based more on price data, because that can tell you in more granular detail what weights might be appropriate for a portfolio to achieve a certain, hopefully, expected return for a given level of risk. But that again is for typically more advanced investors. That's for quantitative investors. So to just kind of wrap up here, so diversification can be measured in a variety of ways, some that depend on the characteristics of the assets themselves and others that kind of depend more on price history. But there's really no single metric or method for diversifying a portfolio that can be used in a vacuum. It's very important to use a variety of metrics in conjunction with one another, such as the ones that we talked about today, to achieve a level of diversification that's kind of appropriate for your unique investing goals. So hopefully y'all found that interesting. It was kind of fun putting it together. And then I think for some pieces in the future, would love to talk more about like the process of diversification and what that actually looks like. Because again, that's a very personal process, but I think there are some fundamental like tenets or rules that might help guide that process a little bit.